Hey, what's going on, guys? Neil here, bringing you a brand new video. Hope everyone's having an awesome day. Today, I wanted to bring you guys a video on a bunch of things that I wish I knew before investing. I've been in the market for quite some time now, and I've studied the markets in the previous history, and there's definitely some things I've learned on how markets operate. And if you guys could learn something from this video, that would be amazing, and maybe avoid some of the mistakes that I've made in the past. So the first thing to understand when it comes to markets, whether it's crypto, stocks, real estate, any really assets, when it comes to investing, is that volatility is always expected. And there's going to be periods of time where we're going to be in extreme bear markets. And what bear markets are defined as a couple different things, but typically means when the market's in a long-term correction. So with Bitcoin, you can see here that, from the 2014 top of about $1,000, we dropped 80 from top to bottom. It was about 85%, a little bit more, and it took about 426 days, so over a year. And this was in 2015 where the bottom was, and then it took another 2 years for it to even reclaim its old highs and break new highs. And this has happened time and time again in crypto. We've seen 85% corrections after a blow off top, and the market usually cools down for a year or two until the next halving and then the next cycle. So markets typically move in cycles, and that's something to keep in mind and understand that volatility is going to be expected. And if you are going to be someone who is investing, you have to understand what you're investing in and not to panic when the market drops, and understand why you're investing. So let's look at the same type of deal when it comes to the S&P 500. So we're just looking at some of the top indexes for each asset class. S&P 500 dropped in the 2008 financial crisis from the top of '07 to '09. Took about almost 2 years, and it dropped 57%. And this is going to be obviously, the biggest, safer indexes. Same thing when it comes to Bitcoin, right? It's kind of like the leader in the market. More volatile, stocks or cryptocurrencies dropped a lot more. And same thing with the S&P. Yeah, as Bitcoin, they've had plenty of, 30% plus corrections. So if you're investing and you think, oh, I'm never going to lose money, and you have to understand when you're getting in the market, what you're investing in, what your thesis is, and stick to that thesis when it comes to long-term investing. So let's take a look at the real estate market. Here's the US home price index. It doesn't let me pull up candles here, but you can see in the top 06, we dropped about 30% to the bottom, and this whole drop took 2,071 days. So we're talking 6 years for the bottom, from the top to the bottom, right? And people like to talk about how real estate's a very safe investment, which it can be. It's more of a defensive asset. It usually goes up about 2 to 3% in equity per year, and there's a lot of write-offs that come with it, and obviously the passive income that comes from rent. It can typically be the more safe asset. As you can see recently, it's just taken off in a berserk way from the bottom, right, for it to reclaim its highs. So we talked about Bitcoin taking about 2 years. This took about, let's put us over here, to reclaim new highs. It took another 4 to 5 years to even break new highs again. So that's why you have to understand and be a long-term investor in these markets if you're just trying to set it and forget it. And this is how you can build long-term portfolios for growth. And then you can take a look at the S&P if you want to see how long it took. This was 09 when the bottom hit. To break those previous highs from '07, from '09, let's say we take it about here for new highs, it took about exactly 4 years. So you have to be patient when it comes to these things and understand that we go through cycles that are affected by a lot of macroeconomics. So definitely keep in mind all these things when investing. Understand what you're investing in, what the risk is, right? And that's really going to save you from a lot of headache, and kind of have a plan, right? Am I going to dollar cost average? Am I going to trade? Am I going to take profits at a certain amount? Am I going to take out my initial investment at a certain amount? Am I going to sell everything at a certain price, right? Have a plan and stick to it. I always tell people personal finance is called personal finance for a reason, because everyone has different goals, risk tolerance, wants, needs, etc., right? So my portfolio is probably not going to work for you, and your portfolio is probably not going to work for someone else, right? So have a thesis, have a plan, and stick to that. So next thing I want to talk about, aside from volatility and cycles, is market price. So I think this is just some key takeaways from Investopedia, which is a great website to understand some terminology when it comes to investing and finance. So key takeaways. The market price is the current price at which a good or service can be purchased or sold. Market price of an asset or service is determined by the forces of supply and demand. In financial markets, market price can change quickly as people change their bid or offer prices, and as sellers hit the bid or buyers hit the offer. So a key thing to take away here is that a market price of an asset is determined by basically what the next person is willing to pay for it, right? What it can be purchased or sold for. Everything boils down to supply and demand, right? How much supply is there? If there's a limited supply and increasing demand, obviously the prices are going to go up. And when it comes to financial markets, like stocks or crypto, these prices move a lot quicker and in real time because there's buyers and sellers in the market willing to buy and sell for different prices. So when it comes to real estate, it's a lot more liquid. So that's typically in the past why it moves slower, because it takes a long time. Let's say you need to sell your house. It's going to take time for you to list it, find a buyer, etc., right? Whereas if I want to sell a stock or cryptocurrency, it's going to be almost instant. So to understand that everything boils down to supply and demand is very key. Obviously, there's other markets, other factors that come into play when it comes to these markets, right? Like the government policy and all these different things, the fundamentals, right? But understanding this key concept is going to save you a lot of headache in the future, and it's going to let you understand how markets move. So moving on, I wanted to talk about market narratives. So here's another article. These are examples of narratives of drivers. Bitcoin, fiat currency is debased. Worker shortage, passive indexes, right? The S&P has outperformed majority of hedge funds in the past 10 years. Inflation, valuation. Valuation is another thing to understand when it comes to, stocks, but just because they have a certain valuation or a certain PE ratio doesn't necessarily mean, or certain earnings, let's say, earnings only happens every 3 months. What moves the market in between that time is all narrative, right? It's all supply and demand. Meme stocks was a big hype, when there's massive short squeezes in GameStop, AMC, etc. So I think, the key takeaway here is to understand that there is a lot of things that move markets, right, that we've talked about here, like supply and demand and these other fundamentals, right? But what it comes down to is narratives have a lot to do with influencing the market, right? If someone thinks something's going to happen and a bunch of people are thinking the same thing, then that's probably more likely to happen because more people are going to hop on that train. There's going to be increased demand for that asset, which is therefore going to increase the price, right? And that's some of the great things to understand when it comes to narratives, and there's different narratives in each market. With crypto, it might be, first it's layer one blockchains, then it's going to be gaming coins, then it's going to be DeFi. There's all these different things that come with it. With stocks, it could be, it's tech stocks, it's value stocks, it's healthcare stocks. And these narratives usually flip depending on what is the driver in the market currently. So a couple more things I wanted to cover. So I hope you guys are getting some value out of this video. If you guys are, definitely drop a like, comment, subscribe, share the video with a friend if you think they can benefit from this. And let me know down below if you guys have any, constructive criticism or other videos that you guys want to see. So let's talk about long-term and short-term capital gains. So another thing you have to think about is capital gains tax. If you live in the US, that is, at least. There's a few ways to get around it if you don't, and a few countries that let you get around capital gains or have zero capital gains, like Dubai or Puerto Rico. But if you live here in the US or in other countries with capital gains, I'm just going to specifically focus on the US so we can talk about certain rates. Let's talk about capital gains for 2022, this current year. When you sell an asset, let's say you buy something for, $50,000, and then you go ahead and sell it for $100,000. Then you're gonna have to pay taxes on that $50,000. And what's going to determine that is if you hold it for a year or more, you're going to pay long-term capital gains, which is almost always lower than short-term capital gains, which is going to be anything held for under a year. So this applies to, everything when it comes to stocks and crypto, and even real estate, you're going to have to pay capital gains on as well. There's other taxes that come with that as well, like property taxes. So let's talk about single, up to 41K. If you made up to 41K from income and investments, then you're not going to have to pay anything, which is great if you're filing as a single person. 15%, which is probably a lot of people fall into this category, is if you make from 41,000 to 460,000. And then 20% is going to be if you make over 459,000. And let's just talk about being a single currently filing by yourself. So this is something you do have to think about. Sometimes taxes can influence you to make the wrong decision, but at the same time, you do have to think about that and take that into account as, with a W-2, typically most people on their 9 to 5 jobs, you're getting taxes taken out immediately. So even though you are being taxed at a high rate, typically you don't really see that as it comes out of your paycheck. When it comes to capital gains and selling assets, you have to prepare. If you sell 50,000 and in assets and you gain 50,000, let's say profit, you have to think about 15% of that or 20% of that, depending on your income, or maybe zero, is going to have to be put aside so you can pay taxes when tax season comes around. Which tax season is literally right now, right? Taxes are due in 2 weeks, so it's something to think about right now. Short-term capital gains. So this is a good example. For example, if you have 80,000 taxable income from your salary and 10,000 short-term income, total taxable income is 90,000, right? So as a single person, you'd fall into the 24% range. So let's say you made 10,000 in capital gains, but your income falls into this rate, you're gonna have to pay 24%. Even if you make only up to 9,950, you're still gonna have to pay 10%. And then if you look on the high side, we're going to be talking about 37% if you're a single person making over 523,600. So that's a ton of money that's going to be going to the government. So like I said, sometimes taxes can make you thinking about taxes can make you make the wrong decision because you don't want to pay taxes, and then you don't execute your plan as you kind of had it written out initially. But sometimes it can help you make great decisions as well. And there's ways around these taxes with write-offs and different things that you can do to try to minimize your taxes. So it's definitely something to think about. If you guys want to, if you guys haven't done your taxes, check out TurboTax below. I'll put a link so you can get 20% off in the description below. You definitely could check that out, and they make it super easy to file your taxes. So last thing I want to talk about is compound interest. So compound interest is exactly what it kind of says here, how much your money can grow using the power of compound interest. So currently I'm 26 years old, right? I'm young and I have a lot of my life to live, so I understand that, hey, compound interest, if I start investing now, is going to help a lot long term, right? So that power of compound interest is, let's say you have 10,000 invested in the market, you make 10% your first year. You're going to be making 1,000 on that portfolio. But typically when it comes to stocks or crypto, at least, you're going to be reinvesting that in your portfolio, and that's how it's going to compound on itself. So even if you don't add anything to it, next year you're going to have 11,000 invested in, let's say you make 10%, and bam, you're going to make 1,100, which doesn't sound like a lot more, $100 more, but this compounds at a very rapid rate, especially if you're going to be investing for the long term. So here I put the estimated interest rate as 10%, which is average return of the S&P 500 since inception, which is the most traded stock or ETF on the market. Put length and time to 35 years. So if you're 25, this will take you to about retirement age, 60 years old, $500 a month. So this is kind of like a perfect example for a Roth IRA, because $500 a month becomes $6,000. So then you're going to have a Roth IRA that's going to be tax-free. I have a video on the difference between the different retirement portfolios or retirement accounts. If you guys want to check that out, check out my channel as well. It'll break down all the tax differences and max contributions and all the different things that come with it. So let's say you start with zero. Pretend this is your Roth IRA, so you're going to be putting in post-tax dollars, meaning that everything you compound this to is also going to you've already paid the taxes on it, so you'll have this completely tax-free, which is huge. $500 a month, 35 years. You calculate that. 35 years, you'll have $1.6 million portfolio, and you'll have only invested $210,000. So you can see the longer you go, the more this money is going to compound on itself. And even if you can't put in $500 a month, you can obviously check out this compound interest calculator and mess with the different ratios and the length and the estimated interest rate and contribution, whatever works for you and however much you're starting with, right? So these are just some things I wanted to go over, kind of like some macro topics when it comes to investing. For me, when I first started, these were a lot of things that you kind of have to learn the hard way, kind of have to learn it by doing, but that's what I'm here for, is to help you guys out on your personal finance journey. I love helping you guys out. So if you guys have any questions, feel free to reach out to me on Discord or any other of the social medias that I link down below. If you guys want some free stocks or crypto, definitely check out the links below as well. Just some easy sign up affiliate links so you can get some free stocks and crypto just to help you starting out. And I hope you guys are able to gain some value out of this video. I'll catch you guys next time on the next video. Thanks.